It's the last Friday of the week, and for the month of October, quite an interesting month across the continent. Hello and welcome to Africa Business Weekly. I'm Akin Obake. Now, this episode promises to be intriguing as we dive into key discussions shaping the business landscape in Africa. Let's get a sense of what to expect on the show today. In Southern Africa, we bring you an exclusive with the governor of South Africa Reserve Bank on monetary policy management and a host of other topical issues. We look at how East Africa region is positioning itself to shape the trade agenda in Africa. And in West, we unpack a report by the AfCFTA on Ghana's pension funds. Let's get right into today's show as Karabo brings us up to speed with stories from the South African region.
Good evening, Akin. Well, South Africa's monetary policy management has been roundly lauded around the world since the dawn of democracy. Now, in an exclusive interview, CNBC Africa sat down with the Reserve Bank Governor Lesetja Kganyago, the 10th governor of the revered institution. He spoke on a host of issues, including gold strategy, stablecoin risks, and third-term priorities. Let's listen in for more.
Monetary policy does not just work on a one-year horizon. We work on an 18 to 24 months horizon. So if you take the horizon as a 12 months horizon, we might arrive at a wrong conclusion. But let's take it that that period includes the 6 months before my reappointment, since in any case my reappointment took place way ahead of the expiry of my second term.
All right.
So
okay.
so that helps. That helps. But I would say to you that reflecting on the period, it was a tumultuous period. We had the imposition of tariffs by the United States that created a lot of uncertainty in the global economy and in the global financial markets. It also led to a breakdown of some important relationships. The models would have said that a country that imposes tariffs will end up with a currency that appreciates. That is what we saw with the US dollar. It appreciated after the first announcement of the tariffs, but since then it has depreciated, and year to date, the dollar index, which includes 10 other G10 countries, had actually depreciated. And the US dollar had also depreciated against lots of other emerging market currencies. So that was the year. It was a year full of uncertainty and particularly challenging.
And when you look back, Governor, and I'm sure as you do with your colleagues, and you look through the year and you look at what you did, do you sometimes get the sense that perhaps you could have done this way and then gone perhaps the other way with this particular decision? That I'm looking back on the monetary policy year that was.
No, these things, that's why you emphasize uncertainty. So what we would do is that we will have a central position, and then we will have the alternate positions. And what we have been doing over the past 2 years, which is something we learned during COVID, was to start putting scenarios, because the uncertainty is so much. So in January, for example, we presented one of the scenarios, and one of the scenarios was that AGOA will be ended, and after the ending of AGOA, the US will impose 25% tariffs on South Africa. We modeled we modeled that scenario. Well, we were correct in the sense that AGOA was not there, but we said 25% and we ended up with 30%.
You were 5 percentage points out.
Yes,
it's not too bad.
Yes, but the expected impact was that it would have an impact of about 0.3% on economic growth. We also expected inflation to tick up a little, but both scenarios didn't play out that much. Growth, yes, did get impacted, but inflation, the situation turned out to be the opposite. And the reason it became the opposite was because instead of the dollar appreciating, the dollar depreciated. So we played out with that scenario. Hindsight is always perfect, but that is why it is also always important for central banks to regularly evaluate their frameworks and regularly evaluate their their performance.
The African Development Bank has approved $75 million in financing for Nyanza Light Metals to build an 80,000-ton-a-year titanium dioxide pigment plant in the Richards Bay Industrial Development Zone. The project aims to cut costly imports, create thousands of jobs, and place Africa at the heart of the global titanium value chain. Now, for more, CNBC Africa spoke to Donovan Chimandamba, who is the CEO of Nyanza Light Metals.
The first thing to understand is that what we are driving at is to try and build industrial capacity that's aimed at beneficiating local resources. So if you look at South Africa and Africa in general, we sit with quite some vast resources when it comes to titanium. So the likes of Rio Tinto or RBM, as you'd know it, or Tronox's, they mine this resource and export it in its primary state. And when we export it, it's at values as low as $300 a ton. And then we import back the final product, which is called titanium dioxide pigment, at $3,000 a ton. So basically, there's a 10x value jump in terms of what the country and the continent is missing. And what our primary focus is to build that industrial capacity locally and not be importing back the high value added product. So what Africa is witnessing, or what we're having with this deal, is actually spearheading the growth and the build-up of this industrial capacity that does mineral beneficiation.
Sure. How long will it take, but are you planning for it to take, to put the continent on a better footing when it does come to the import situation?
So the construction period is 3 years. So end of 2028, early 2029, we should see production coming into play. I think Africa imports just over $600 to $700 million in worth of value. What you will see with us replacing almost half, or just over half of that value, that imports, or those imports, in terms of value. And I think more importantly is that even after 36 months, once we've built this titanium plant, it unlocks the potential of further plants of beneficiation and high value addition plants to be built in the battery materials sector. So the greatest impact is on import substitution, and also it will help all these paint manufacturers, which largely use paints and plastics. So they sit with high inventories because they have to stock to cater for the supply chain lengths they import from China, US, and Europe. And if you have a plant that's close by, that will also boost their working capital cycles by having the material close by, instead of them trying to cater for the 8 to 12 weeks lead times.
Yeah, no, fantastic. And also an interesting spin-off, as it were, that you've also highlighted or alluded to by way of unlocking the capacity or the ability to manufacture batteries also on the continent. Talk to us a little bit more about that, and just how far down the track that could potentially happen.
So one of the byproducts that we make is a precursor into the lithium-ion batteries. So in China, what you would find is when people build these titanium plants, they actually build them together with the lithium iron phosphate manufacturing plants. Now that project is already underway. We're busy pushing the feasibility studies again with some of the same banks. As soon as we complete construction of the titanium plant, we anticipate to be commencing with the construction of that second phase. So just to give you context in terms of scale, the titanium plant is $870 million that AfDB is participating in.
And those were some of the stories shaping the Southern African region this week. Do stay tuned for more updates across the rest of the continent. But from me, it's goodbye for now.
Thanks, Karabo. A beautiful evening to you, Tabitha. What's cooking in East Africa?
Hello and good evening. East Africa is an emerging market drawing in global investment in various fast-growing sectors such as trade, real estate, mining to ICT, you name it. But with growth numbers looking up, how is the region positioning itself to shape the trade agenda? We spoke to Eric Ruto, president of Nairobi's Chamber of Commerce, for more.
As we come to the AGOA, of course, our prayers was to see whether we could get an extension for AGOA. We've had almost like a quarter century, that is 25 years from the turn of the millennium. Just ended 30 days ago. And as this was a big opportunity for Africa, yes, for Kenya maybe specifically, we were able to export goods worth almost $100 almost 400 million US dollars to the US. And I know quite a number of other African countries who are accessing tariff-free, quota-free to the United States of America. And with the non-renewal of this as a Chamber of Commerce, we are looking at, of course, quite a number of opportunities that could be able, that we can be able to tap into so that we can be able to fill the gap. But maybe a little bit on my explanation is that you can see, for instance, for Kenya, and I think quite majority, almost 90% of the countries in Africa, is that the tariff rate does not significantly disadvantage African countries, especially if you see, like for Kenya, I will give you an example. Even with the 10% tariff, duty tariff to the USA, is that we are still very competitive if we compare ourselves to other countries such as Bangladesh, I think, and other East Asia, Southeast Asia countries. So we still have the lowest rate. So therefore, Kenya and at large East Africa is still competitive for us to be able to export to the USA. In fact, I would say right now, our goods will be the most affordable in the US market. But of course, I know because of issues of duty, there's going to be a little bit slumped consumption because of inflation in the US. So that could be something in terms of demand that we could be able to have a problem on that line. So the demand might slow down the investments and the growth of our exports to USA.
Quite some fundamental.
The other thing, yes, okay, yes, thank you very much.
Sorry to jump in. I just have a lot to bring out in the interest of time.
Okay.
But just listening to your very insightful insights in terms of looking at the potential for trade, I'd like to know, as a chamber, what sort of initiatives have you put out when it comes to ensuring that businesses are able to tap into the AfCFTA protocol? And are you seeing this as an area that has immense potential for not only Kenya, but for East Africa at large?
We have to look at what we call the internal competitiveness. So we've been looking at, especially now, to increase the number of businesses that are participating in inter-African trade, increase the volume for the companies already that are there. So we have looked at three issues during our economic surveys that we usually conduct quarterly. And the first issue we identified is a cost of finance for businesses to be able to expand and even increase their volumes. The second one is the cost of doing business, and part of it is in terms of power and in terms of cost of regulatory and local taxes. Yes, we have had almost a 1.5 year engagement with government, and I'm seeing some of the cost of benefits. We're also looking at reducing the cost of raw materials, and we have seen some of the government programs that has been able to do that too, especially in the agri-based industry, because our main exports come from agricultural raw materials. So we've seen quite a number of investment in terms of infrastructure, in terms of extension services to the farmers, fertilizer subsidies. So those are some of what we call the internal issues in terms of increasing our competitiveness.
Kenya has 7,200 high net worth individuals, each worth at least $1 million US. We spoke with Mwathi Kilonzo, Managing Director of NCBA Investment Bank, on how policy, technology, and investor behavior are reshaping wealth in 2025.
You know, what we're seeing certainly from investors is that people are changing how they think about financial investments. So we're seeing very large growth in terms of uptake of unit trusts. And I think this trend, it's not just in Kenya, we're certainly seeing it across the region. And I think you can find the same trend across many African countries. So this is sort of the idea that you can now have a financial investment, something that can accrue interest on a daily basis, and it's easy to get in and out. You can top up or you can withdraw at any point and any time that you want to do so. I think the other thing we're also seeing is certainly a need for diversification. So we're seeing the breadth and the number of products that are coming. So the competitive landscape is certainly becoming a lot more complicated, but for the investor it's great because they're now starting to get choice and variety of different products from different houses, which means it's that diversification and just more things that you can do with your money. So it's certainly a very exciting time to be. And, we hope this trend continues to grow because I think this eventually will find itself way back into the capital markets and fund investments in the country, and also allow capital markets where good companies can raise both equity capital or even from the debt capital markets as well.
Yes, and can you say that some of these changes maybe are driven more by technology, market volatility, or even generational shifts?
I think I would start with the latter. I think there's a generational shift and there's a lot more exposure. So people have traveled, people consume a lot more information. So they can actually see that the world is a lot bigger. And I think that has driven risk appetite. So, for example, people will start looking at commodities, and you can see this trend. I mean, you can see, say, for example, the recent Satrix ETF on the NSE. You've seen it there's a new gold ETF as well. So you're seeing that people are basically casting a much wider net across the world. In our industry, particularly on the wealth management side, where we see that is, for example, in some of the global funds. For example, we have NCBA global funds, both an equity and a bond one, and we're seeing a lot of demand for these types of products because these are giving you a diversified view of the world. And that is driven by a need to diversify and perhaps a reflection that our capital markets hadn't grown as much as they should have, although we're starting to see a really nice market change in that dynamic. And we hope that continues and we see more companies come to market and more bond offerings. And then that really will start to deepen the market and make it a little more interesting. So it's generational, it's technological, it's exposure, and really I think also there's a proliferation of products here which allow people to invest externally.
Yes, and looking at the global inflation pressures that we do have, looking at the rising interest rates, so how should investors rethink risk management in their portfolios?
I think you really have to think about where are you in your life? Are you a retiree who's basically looking for capital preservation and income, or you're a younger person who can basically take a little more risk and can be diversified in that sense? So I think it really depends on your personal circumstances. But I think the most important thing, obviously, is to protect yourself. Whether you are a risk taker or whether you are someone who's very cautious and looking to preserve the capital, there are products for everyone. So what I always say is, talk to your advisor. I mean, if you're in the situation, if you come to NCBA, for example, we'll have a wealth advisor who will sit down with you and risk profile you and understand what it is that you're really trying to get and recommend investments that are suitable for you. I mean, suitability is a really, really important thing that we take very seriously.
Curtains close here on East. Back to you again.
Well, that's it from the East. Now to stories from West Africa. A new report by AVCA, supported by British International Investment, finds that Ghana's pension funds alone could unlock over $1 billion in long-term capital for private equity, venture capital, infrastructure, and real assets if they fully utilize their current investment capacity. Looking ahead, the report notes the evolution of the country's pension industry will depend on the strength of its enabling environment and stronger institutional partnerships between pension funds and private capital managers. Abi Mustafa Maduako, CEO of AVCA, joined us for more on the journey ahead. Take a listen.
Over the past 5 years, it's grown by about 3x. So now this industry is worth about $6 billion. And what's interesting about Ghana is they have the cap. So they can invest 25% of their assets under management into the private capital asset class. But the reality is it's 1.1% of that AUM that's being allocated. And this is not new to Ghana. We see this across Africa. Nigeria is also not an exception. But what's interesting for us is of that 1.1% that they're currently allocating to alternatives, only 0.5% of that is to private capital. So that's to private equity. If we exclude REITs, that's to private equity venture capital. So this 1 billion number that's almost like clickbait, it comes because if they fully leverage that 25% of their AUM, that could unlock 1 billion for this industry. And to give you a bit of context, the industry has raised about 30 billion over 5 years. So this is a significant amount of capital that could be coming just from Ghana.
Yeah, but what are the most immediate shifts that need to happen from the regulatory standpoint to make this a reality?
Okay, so things are happening already. Before going into the regulation, I mean, the government, they put a policy directive that pension funds should allocate 5%, at least 5% to the private equity asset class. So if that happened, that would instantly unlock about $200 million. So that's the policy directive. On the regulation side, maybe I'll start by talking about some of the barriers to this allocation. So firstly, before a Ghanaian pension fund, corporate trustee or pension fund manager can allocate to a private capital fund manager, they need to be domiciled and licensed in Ghana. So that process, very similar to Nigeria, has to go through the Securities Exchange Commission. So sometimes what we've learned from the reports, from doing this report, is that sometimes this process is quite lengthy and it's onerous. And because of that, it doesn't incentivize fund managers to come and be part of that process. Ergo, the pension fund managers can't allocate to fund managers that are not domiciled there. So that's the first thing. The second thing is Ghana doesn't have right now an act that permits limited partnerships. And if you know how private equity works across Africa, it's mostly a GP and LP structure, which is a limited liability partnership. But right now, that's not recognized in Ghana. So right now, private equity fund managers, they set up as holding companies, which means that it's not as tax efficient. So again, if that could be addressed, then it would incentivize more fund managers to set up shop there. And if we have more fund managers, then we have a wider variety, a wider pool for these pension assets to be allocated to.
Yeah, but when you then look at the pension governance frameworks in Ghana, do you think that they have the sophistication that is needed to evaluate and manage the risk associated with private capital exposure?
That's a trick question. I would say yes and no. So maybe I'll just touch on the program that we're doing. So for the past 12 months, we've run a program called a Knowledge Exchange Initiatives, where we've had a fellowship of about 22 corporate trustees. And throughout the 12 months, the whole aim of it is to demystify this private capital asset class and also to equip them with the right, I guess, skill set in a non-patronizing way, with the right skill set to be able to confidently evaluate fund managers and confidently assess the risk. So I think part of it is there is the education side of things, which we are handling as well as other organizations. But also in terms of the sophistication, I think when we speak to them, or we spoke to them for the report, there are a couple of concerns they had. A, they're used to allocating to government securities. You know, they have a cap of 75%, they're on 72.9% or something very close.
And in Nigeria, the CEO of the CFG Advisory, Tilewa Adebayo, says the valuation distorts the reporting of total debt in naira or in dollars. He further stressed that foreign debt must be reported in dollars and not converted to naira, and vice versa for local debt. Meanwhile, Nigeria's National Assembly has approved President Bola Tinubu's request to secure a $2.34 billion in foreign loans to part-finance the 2025 budget deficit and refinance Nigeria's maturing Eurobonds. He joined us earlier for more on these discussions and Nigeria's borrowing plans for the year. Take a listen.
The fiscal reforms are more important than the tax reforms currently going on. Having said that, I think what is happening with the debt profile now is that we're seeing a transition. The $15 billion savings in subsidies are finally beginning to enter into the system, and it's providing quite a bit of significant relief in terms of the burden. And as you can see, state governments are getting more allocation of funds. But having said that, our debt profile, I think, is something that, while manageable, primarily because we've stopped ways and means financing, and all debt obligations now are market-based securities, both local and abroad. That way we have the transparency in managing the sort of debt we have. But it's time for us to take a look at our renewed debt sustainability in terms of the medium-term debt strategy exercise that was recently concluded.
Yeah, but from a structural standpoint, how do you see the debt mix for Nigeria, looking at the local and foreign borrowings?
Yeah, like I said, I think what is important is that we tend to distort our debt profile by reporting in dollars, because our foreign debt really is about $40 billion, just over $40 billion, and our domestic debt is 80 trillion naira. So if you convert naira to dollars or dollars to naira, you get this sort of distortions. So I think it's important that we try to focus the domestic debt in naira. And the irony is the fact that 40% of the domestic debt, of the 80 trillion of that domestic debt, about 30 trillion, is actually Ways and Means from the past governments. And I think that really shows you that, Ways and Means has really impacted negatively on this government. And the fact that they've stopped it, I think, is why we are seeing significant amounts of stability. So we need to take a look at how we report our debt profiles.
So is it more about reporting? Because now you also argue that that the devaluation distorts the debt reporting.
Yes, because when we devalued, for instance, if you take a look at the debt to GDP ratio, for instance, now, right now, our debt profile in naira, in dollars, is about $100 billion. And if you take a look at $100 billion against a GDP of $250 billion rebased, you're looking at about debt to GDP ratio now of about 45%. So this is really where you see that. So by the time you're converting naira now you're converting $40 billion at a rate of 1,500 into naira, you're beginning to see that debt profile, as far as naira is concerned, is going to increase significantly. If the exchange rate drops to 1,400, then you can see all of a sudden, without doing anything, your debt profile has reduced. So these are the sort of distortions that we need to discount when we take a look at the debt issues. But again, there's still some fundamental issues with the debt because we are not really following the tenets of the Fiscal Responsibility Act. And for me, this is an act that needs to be, we need to update this act because it was passed in 2007 to act as what I would call a financial circuit breaker. So there are many tenets of these Fiscal Responsibility Act that we're no longer able to keep in line with. And I think there's now a need for us to upgrade that Fiscal Responsibility Act.
And that's all we can take on this episode. You can catch all these stories and more on our website on cnbcafrica.com. Thank you for joining us today. Until next time, stay informed and stay ahead with Africa Business Weekly. I'm Aki Obakeye, and we'll see you again same time next week. Bye for now.